Welcome back, and a very good morning to those of you who are joining the conference now for the first time. I'm delighted to be able to welcome Victor, Executive Director from Eurosif, to start our next session. Here you are, Victor. Yeah, good to see you. Hello, good morning.
Good morning, David. Thanks for having me. Ladies and gentlemen, yes. Welcome. Oh, sorry.
No, I think we've got interference, but the subject's actually at the heart of your day-to-day work. So I hand over to you to structure the discussion and introduce the important topic. Thank you very much, Victor.
Thank you very much, David. So welcome, ladies and gentlemen, to this very exciting panel this morning on ESG. Is sustainable investments moving into the mainstream? And I think it's clear that sustainability is front and center of all the discussions we had in the last 2 years. If you've seen last year, the calls for a green recovery following the COVID pandemic, we see rise in ESG investments, sustainable investments, that the buzz is very clear in the financial industry. Only over the last couple of days, we've seen the G7, coming out with a statement making climate disclosure mandatory in the future. We're seeing an increasing number of commitments by countries, by companies, by financial institutions to reduce their greenhouse gas emissions in line with the Paris Agreement. But equally, we've seen in May the International Energy Agency coming out with its net zero 2050 scenario. And I think if you read that, you see the gigantic magnitude of the task ahead of us in terms of transforming our economies to meet those objectives. So this panel is incredibly timely, and I'm delighted to have an outstanding group of panelists today to discuss the issue and hopefully provide some insights to you on the latest of what's happening. But maybe I'll introduce panelists one by one, and first turn to Paul Tang. Paul Tang is a member of the European Parliament. He's been the leading MEP on the Econ Committee focusing on sustainable finance. He's represented the European Parliament in the negotiations on the Sustainable Finance Disclosure Regulation and presented his political group, the S&D group, in the negotiations on the European taxonomy. So maybe, Paul, if I can start off with you. We're seeing European countries coming out of COVID lockdowns. Social issues are likely to be at the forefront. This crisis had an impact. How do you see the EU sustainable finance agenda reflecting the social dimension of sustainability more than it has before? Over to you.
Yeah, thank you, Victor, for this question, and it's good to be here. Let me first start by saying that it strikes me that this period is very different than after the global financial crisis, right? So that's good. After the global financial crisis, I was in national politics, but then we were discussing already in 2010 cutbacks. Now the agenda is also very much investment to sustain the recovery, investment also to sustainability, and with the backdrop that the COVID crisis has increased the inequality, upswings in the stock markets, rising housing prices. It has been estimated that the wealth of the world's billionaires has increased in the first half of 2020 by almost 30%. So this is the backdrop of the discussion. So we see investment, but the investment must be sustainable, and sustainability, and that's not just a position from the S&D group in the European Parliament. I think that's a broad position in the European Parliament. Sustainability needs to be broadly defined. Needs not just to be about the E, the S, and the G, but the E, the S, and the G. So social is crucial in this. The transition towards a sustainable economy needs to be inclusive, and at the same time, there is a sort of race against the clock to develop the social characteristics in the disclosure regulation, but also in the European taxonomy. We know that there will be a proposal out on a social taxonomy soon, a first try. The social characteristics, metrics in the disclosure regulation are not satisfying the European Parliament right now. So it's work in progress, and at the same time, you must realize, at least the politicians do, must realize that the transition needs to be inclusive to be really sustainable. this is what is at stake, and this is to kick off the discussion. Of course, to the last remark, what we aim for is now disclosure and transparency. But at the end of the day, it goes into the responsibility of the corporates and the financial institutions. It's not just enough to disclose. You also need to show that you take the risk on sustainability, broadly defined, into account when investing in corporates. That's a way of introduction.
Thank you very much, Paul. So maybe now if I can turn to our second distinguished speaker today, Marcel Haag. So Marcel is director at DG FISMA in the European Commission, responsible for horizontal policies, amongst which, of course, sustainable finance features prominently. So Marcel, if I can ask you, since the 2018 Action Plan on Sustainable Finance, we had a European Commission where we had, focus on finance and sustainability. Obviously, since the last couple of years, we have, on the President von der Leyen, the EU Green Deal, which is a much more holistic agenda for the entire economy. And we understand that the European Commission may be working on a new strategy, multi-annual strategy in sustainable finance. So how do you think that those new realities will be reflected in your work going forward?
Yeah, thank you, Victor, and good morning to all. Indeed, a lot of things have changed since we presented the first Sustainable Finance Action Plan in 2018, and what appered to be a bit of a sideshow at the time has moved really to the center stage. The European Union is firmly committed to becoming a sustainable economy. Our goal set out in the European Green Deal is to make Europe climate neutral by 2050, and that's a very ambitious goal. With the recovery, with the pandemic, we also have to make sure that the European economy recovers fast. And here we have the opportunity, and Paul has spoken about it. We have a real opportunity to make that recovery, to use that recovery as an opportunity to make Europe's economies and societies more sustainable, and the Commission is intent on seizing that opportunity. And for that, we need a holistic approach, and that means that all EU policies, and not only finance has to contribute, but finance has a very important role to play here. In 2018, we laid the foundations, and that has made Europe one of the front runners in sustainable finance. We're one of the first jurisdictions actually developing an ambitious sustainable finance framework. But things have evolved, and the global context has also changed, and that's why, and Victor, you mentioned it, we now think that we have to build on our action plan of 2018 and present a complementary strategy. And we're going to do so in the summer. And let me mention maybe 4 points that we want to address. The first one is transition. We want to provide the tools and policy that should enable all economic actors across the economy to finance their transition path towards sustainability, and that goes beyond the mere climate goal. Secondly, Paul insisted on that, inclusiveness We need to make sure that we cater for the needs of all citizens and of all companies, including SMEs, in our sustainable finance policies. We also have to make sure, and that's my third point, that the financial sector itself does not only contribute to the greening of the real economy, but pursues its own greening and becomes more resilient and more vigorous in fighting greenwashing. And finally, the international dimension. We need to promote an international consensus on an ambitious and a global sustainable finance agenda. We should aim to converge at the highest possible level, but we should also give us the possibility to go beyond what the international consensus could be, obviously building on it. So the new strategy will be an opportunity to ensure that the recovery delivers on the green transition, that we better respond to our climate change challenges, and that we make sure that environmental and climate risks are better integrated in our financial system and in our economy in an inclusive way.
Thank you very much, Marcel, for those opening comments. Now, if I can move on to our next speaker of today, Ingrid Holmes. So Ingrid's been a long-term sustainable finance advocate. She was also a member of the initial high-level expert group in 2017, which produced a report and some recommendations for the Commission's first action plan. And more recently, at the Green Finance Institute in the UK, has been appointed, I think fairly recently, to lead the UK government's working group on the UK taxonomy. So, welcome, Ingrid. And I think, I'd like to ask you, as a member of the initial H-leg, what we've seen over the last couple of years in terms of sustainable finance, is that what you initially had anticipated? Is that what you were aiming for as a member of that group?
Thanks, Victor, for the question, and thanks for the invitation to be here today. I think I was quite surprised, very much positively, at the pace and scale of regulatory change that we've seen. Shortly after the Sustainable Finance Action Plan was launched, I decided to move back into asset management, as I was quite keen to work within a progressive firm on implementation and try to wield whatever influence I could on the legislative process to ensure the rules were fit for purpose in what we were trying to achieve. And it's been really interesting to see how this agenda has been engaged with and then has impacted on regulated firms. And I'll just quickly look at the SFDR, the Sustainability Related Financial Disclosure Regulation, and taxonomy for a moment. So as with all EU regulation, it's moved very slowly and then very, very fast, almost taking people by surprise, even though we've been talking about these new rule changes for more than 3 years. Sitting within a progressive firm, in terms of implementing the SFDR, it was a huge amount of work to document all the activities that the business was undertaking to integrate sustainability factors into investment decisions and to start thinking about these new ideas around reporting on double materiality. It also caused a lot of angst as some important elements in promoting a financial system, so ideas of stewardship and engagement with corporations on some of these transition issues have not been included in the different product classifications. So there's more work potentially to do there under the next Sustainable Finance Action Plan, and I understand that is potentially on the cards. But I think what was perhaps more interesting for me was seeing the impact of these regulations on the wider industry. I talked to a lot of clients and also peers that had been starting to engage with the ESG agenda, which was positive, starting to think about developing products, but then realizing when they looked at the SFDR rules, they weren't doing enough to meet these new high bars. And I think that was the point. What we set out to do in the high-level expert group was to work with the Commission to find ways to mainstream climate change and wider sustainability considerations into capital markets regulation. It was a revolution, and to see sustainability factors start to be properly integrated into investment practices. And what that means for many firms who are relatively new to this is really significant operational changes to product design, to the information that's taken in, portfolio construction, management, and of course, reporting. It's really a massive shift in the market. So of course, you were going to see some firms struggling with it. And so I think from that perspective, the H-Legs work and then the Commission's response to that in terms of how the ideas were implemented, while clearly not perfect, is, I think, very much a force for good. And I'll just finish on the taxonomy for a moment. It's really, really positive to see the international impact the taxonomy idea has had. We're seeing them developed in the UK. I'm leading that work, as you mentioned, Victor, but also in many other jurisdictions, China, Bangladesh, Canada, and a host of other places. And as Marcel said, we need to see international alignment around these taxonomies. I think the EU has definitely got it right with the creation of the international platform, which should be a hub for this diplomatic discussion. Given that finance is global, we really do need to move towards providing an aligned global view for international global financial institutions and corporates on the direction of travel that needs to be taken to deliver our sustainable economy. And I'll leave it there.
Thank you very much, Ingrid. So if I can now move on to our next speaker, Stephanie Butcher. So Stephanie joined Invesco in 2020 as Chief Investment Officer. Invesco, one of the largest asset managers worldwide. Before that, she was a European equity fund manager specializing in income strategies. Thank you for joining us, Stephanie, today. And I guess from your vantage point as Chief Investment Officer for a large asset manager, how are you yourself and your clients responding to these new regulations, and what are your some of your key takeaways up until now?
Well, thanks for having me, and good morning, everyone. I mean, I think a lot of the themes that Ingrid's just talked about sort of sound very familiar. I think the implementation of the first stage of SFDR has significantly extended ESG to the mainstream. And in making the disclosures mandatory, I think the EU regulators created a healthy push for any laggards that were out there to sort of take consideration seriously. I think for us as long-term active shareholders, the notion of sustainability of a business has always been central to success. And that sustainability incorporates financials, of course, but if governance is poor, environmental policies render a business at risk of becoming stranded, or in social policies destroying the brand, then sustainability and intrinsic value are just as affected. And equally, I think there are huge opportunities for value accretion for companies well positioned to accelerate change or provide best practice, and crucially for those improving their performance in any of these areas. And our fund managers are genuinely excited about the opportunities this creates to add value for our clients. So I think to that extent, shareholder and stakeholder and regulatory interests are fully aligned. What I think has evolved is integration is becoming more systematic. ESG integration is the building block covering all asset classes. We do need data to enable this. I think we'll probably talk about that later, and to complement our financial knowledge of corporates and other issuers, as there may be risks and opportunities that financial analysis alone may not identify. We're enabling our investment teams with data and more proprietary tools that help offer those insights. I think as a practical result of regulation, there are more compliance and operational requirements, as Ingrid sort of pointed to, and the complexity that comes with that. But I think also importantly, in terms of actually making a difference and in responding to client needs, it's driven a broader need to be creative in diversifying product offering, introducing rigorous and proprietary frameworks and investment approaches, ultimately offering alpha within an ESG compliant approach. We do have to clearly delineate between financially material mainstream products, which is part of our fiduciary duty, and ESG impact products, which more our clients' choice. It's not up to us or politicians to dictate how our clients invest money, but there's a lot of education we can do and information we can give to enable them to make an informed choice. I'd say that ESG is a central part of every conversation with clients, albeit in terms of what ESG means. It can, that definition can differ. There doesn't seem to be a single definition of ESG or sustainability. So the product landscape is diverse to cater for different client needs and preferences. I think greater harmonization would clearly help the industry and clients, and we do suspect better ESG data is a key prerequisite to get there. But it is clear that investors are more and more demanding on targeted ESG focus of their investments. They want to see evidencing and outcomes that go beyond implementation of ESG good practice or analysis. So it's very holistic. It's working with clients. It puts asset managers at the center of the delivery, starting from the building block of integrating ESG, financially material factors within the analysis, adding ESG-focused strategic investment objectives, influencing via targeted engagement, actively managing via voting, and monitoring reporting outcomes as a result. But I think key from a fund management perspective is that the underlying process is robust and consistent. An integrated process has to drive stock picking and allocation, not regulation per se. And if we're successfully integrating ESG fully into considering risks and opportunities for companies across the entire understanding of sustainability, then risk, reward, regulation and client demand will be fully aligned.
Thank you very much for that. So now I'd like to turn to our last but not least, our other panelist for today, Jane Ambachtsheer. So Jane is the Global Head of Sustainability at BNP Paribas Asset Management, also one of the leading global asset managers, is a member of the task force on climate change related financial disclosures, and was named an investment leader of 2020 by Environmental Finance. So thanks for being with us here this morning, Jane. And a lot of the discussion we're having this morning, and we heard some allusions to that in the opening remarks previously, is that we have this urgency around climate change, but probably also biodiversity, and a lot of that will ultimately have to translate in some changes to the companies investors invest in. And so, what can investors do via their engagement with those companies to orchestrate those change?
Sure, happy to weigh in on that. It's a pleasure to be here today. I think that stewardship, which we would define as really having three key components: voting, company engagement, and public policy advocacy, is increasingly, I think, a key component of how asset managers can really implement the opportunity and the obligation to push for positive change on climate, on biodiversity, on inequality, on any number of topics. So maybe just to touch on each of those three areas. From a voting perspective, we have very, very detailed approach around our proxy voting guidelines, which are publicly available. If we focus on climate, we tend to vote in support of climate-related resolutions more than 90% of the time, and have actually even begun to file resolutions on a particular topic, which is a key focus area for us, which is around tackling corporate climate-related lobbying. So we think it's really important to push for more disclosure from companies on the kind of direct and indirect lobbying activity that they're involved with, and ask them to report on how well aligned that is with the Paris Agreement. So we were pleased this year. We filed a resolution with Exxon, which received more than 60% support, and we also had majority support for one of these resolutions that we filed last year with Chevron. So I think that looking at shareholder proposals, of course, is a really important topic in looking at how the investment community is really pushing for change. I think another key development this year, of course, is around Say on Climate, and the number of Say on Climate proposals that we've seen in the market, the majority of which have also received majority support. So voting, key pillar. Company level engagement, of course, is something that's also incredibly important, and Climate Action 100 Plus, I think, is really the poster initiative, I think the world's largest collaborative initiative, pushing for collaborative change, asking companies pretty clearly to do three things: have a climate aligned, Paris aligned business plan, have a climate competent board, and provide investors with TCFD aligned disclosures. So I think that's been very successful, and we need to keep pushing on that. And the third pillar, I think, is less explored, less developed, is around policy advocacy by the investment community. And just a few days ago, we saw the latest kind of annual letter issued by investors. More than 450 investors representing $40 trillion signed this letter asking global governments to basically increase their level of ambition and have NDCs, nationally determined contributions, that have the appropriate level of ambition around 2030 targets in advance of COP26. So it was great to see this level of support, but I think signing a letter isn't enough. We need to have more coordinated kind of policy engagement to really support governments in making the changes that we need to see on the ground in action to really transition towards a net zero economy. So those three pillars, voting, company engagement, policy advocacy, I think is really a core framework. Just two quick other points. The first is that I think it's interesting to see how more, the asset management community will be judged on the kind of stewardship activity that they are undertaking. And it's pretty easy to compare, and ask managers, why have you voted in support of this or not? Are you supporting some of these, these initiatives around supporting and encouraging policymakers to increase their ambition? If not, why not? So we've seen, share action, majority action, preventable surprises, many different NGOs publishing reports, trying to shine a light on the different approaches that asset managers are taking. And I think SFDR, of course, in the European context, will also put more focus on transparency around these kinds of activities, which I think will help to kind of round out the criteria that asset owners can use when they're selecting their investment managers. The other quick point is around biodiversity, which you mentioned, which, of course, we know that half of global GDP is linked with nature. 80% of the Sustainable Development Goals are at risk of not being achieved because of biodiversity loss. We know that this is a major issue, and I think that there's an interesting opportunity to think about Nature Action 100+, a collaborative shareholder initiative focused on engaging companies to be more transparent in terms of both their impacts and dependencies on nature. So that's something I think that we can look out for in the months ahead, leading up to COP, the biodiversity COP15 this fall. So I'll leave it there and look forward to the discussion.
Thank you very much for those very interesting thoughts. And maybe turning to the discussion. First question I would have maybe, and I would like to maybe direct that to you, Marcel, is I think if you want, sustainable finance 1.0 is very much about defining what we consider as green, what we consider as aligned with long-term objectives. I think, as you've alluded to, particular discussions around something like a taxonomy, one of the often heard arguments is, okay, we've defined where we're going. How do we get there? How do we do that transition journey? So could you maybe perhaps share a bit more, more light on your thinking around how we tackle that policy challenge?
Yeah, Victor, indeed. I mean, our taxonomy is a green taxonomy, so it defines what is, if you like, what activities are dark green. That said, we have always been aware of the importance of the transition, but also the importance of enabling technologies, and there is a provision in the taxonomy regulation that allows us to deal with the transition and with enabling technologies, and we have tried to do so already in the first delegated act. But that said, we have seen in the discussion that more can be done and more needs to be done to accompany companies, but also the financial sector, on the journey towards sustainability, and to accompany and support the way towards becoming green, precisely because this is not a binary choice for the economy to be either green or not green. So we want to do more to support the transition of economies, of activities that are currently not dark green, towards becoming greener over time. And that's what we will be looking at in our strategy, where we want to develop ways to support transition pathways. We want to provide the tools and policies that will enable all actors across the economy to finance their transition plans beyond the climate goal. This will not be easy. It's a daunting task. Already a green taxonomy is a daunting task. We're currently looking into how best we can do that, and we're going to explain that in the new strategy in a couple of weeks' time.
Okay, thank you very much, Marcel, for that. And so maybe, turning back to the market practitioner view here, Stephanie, how do you see yourself as an asset manager in accompanying your investee companies in that journey?
Yeah, so I mean, I think have a lot of sympathy with what Marcel has said. I mean, I think our central thesis rests on the idea of greener rather than greenest, in terms of how we really sort of can make the most incremental change and the most incremental difference. And that involves analysing, obviously, where exposures lie, and then crucially working with the individual companies to assess their ability and absolutely fundamentally their willingness to change, and through the process of very close engagement. And I think that is where you really drive that change throughout an economy. Asset managers have a key role to play in allocating capital, but also as stewards of the companies we invest in. And so I think the focus in terms of transitioning towards a more sustainable economy, rather than solely focusing on new green technologies, albeit the opportunity there is also very exciting. Working with those businesses to really sort of encourage and push and warn and use all the methodologies that Jane was pointing to, which I think I fully agree with. I think that's very much part of our role. I think it's very important to recognise green doesn't necessarily mean lower risk, and we do need to make sure that we protect investors, and we're not sacrificing investor protection for other policy priorities. And I think the risk is in too narrow a focus, is that you risk creating asset bubbles. If we're pushing investors into asset classes with limited supply. So I think this point about crowding in rather than sort of crowding out is central, and that is how you really engender change throughout society that is healthy and works for everyone.
Thank you. And obviously, companies' transition is a long-term journey. It doesn't happen overnight for our entire economies, and it takes some long-term horizon to bear in mind. Maybe turning on to you, Paul, because I know the action plan. One of the ideas in 2018 was to focus on undue short-termism pressures that financial markets may face, while they have to take that long-term perspective. So I was just wanting to hear your thoughts on where we've gone with that, and how far we've gone through the road, and what still needs to happen on that front, from your perspective.
Yeah, I remember reading in the report by the high-level expert group that we need to break with short-termism. And I thought, well, that's a daunting task. And at the same time, I think the high-level expert group was right in emphasizing that we need to break with short-termism, that we need a broader view from investors and corporates, both at the same time, to incorporate people and planet. And I must say, since 2018, I think the response has been positive. So there's no reason. It's maybe a daunting task, but it's certainly not impossible. Markets have reacted to that. Asset managers have reacted to that. So that's hopeful. But to make sure that we also need a structure for markets to make sure that the markets are not just focused on profits and on short-term profits. They need to focus on people and planet. For me, I would say this is the license of operates for capital markets. I always see plea for example, in Europe for the Capital Market Union. Hey, but if the Capital Market Union doesn't serve people and planet, we better not have a Capital Market Union. That's what. So for me, it's the license to operate. Now the good question is, and a difficult one is how to enshrine that it's not just the profit that matters. But it's also people and planet. They have decision by asset managers, by corporates, and so on. Personally, that starts with the transparency, right? That has been discussed, and then we move on to accountability. And before I entered the difficult trade of politics, I was for many years an economist, and it's very simple: put your money where your mouth is. I look at remuneration policies. In many corporates and also financial institutions, they will still reflect profits. So we haven't made a change yet. So I see asset managers, investors, and others that are of goodwill. I see corporates that are of goodwill, but that's not enough because in the end, it's not just about the front runners, it's about the average that we need to lift up, right? And therefore, I'm very interested to also in this discussion to hear from market practitioners what is changing and what. But also look for ways to put it in legislation, because in the end of the day, we need to raise the standards. And this is my simple test. Do we have accomplished that? No, I still see remuneration policy where the CEOs and the board are still remunerated in stocks. And I'm not sure about that reflects, but I don't think it will reflect people and planet. So we haven't come that far. Well, and that's just one of the changes. I think it's a systemic change. So there's not just one wheel to turn. You need many places to make changes to come to a systemic change. And this is, well, you can call it a daunting task, but I would rather call it work in progress, because I think we're heading in the right direction. And who knows where we are 2 or 3 years from now.
Okay, thanks for that, Paul. And I don't know if any one of the market practitioners would want to react to Paul's open invitation, but if you do, please give me a sign. But
I'm happy to jump in.
Sure, Jane.
Yeah, I mean, look, I agree. I think that executive compensation, globally and particularly in the North America context, is a huge issue. This season we voted against 60% of executive compensation packages because we're not able to support them either because we feel there's a lack of appropriate alignment of interests or a lack of integration of key elements, but also a focus on time horizon. So I think that in the context of so much focus on the transition, on climate, on net zero, on COVID, on inequality issues, there's been, I think, less discussion of executive compensation over the last couple of years. But of course, these are systemic issues and we need to talk about all of the kind of major components. And, one of the elements around SFDR is more disclosure of course, executive compensation and compensation alignment throughout an organization in the context of sustainability indicators. So I think it will be interesting to see how much focus is put on that by different market participants. And it's quite a complex area. It's not always easy from an apples to apples comparison perspective, but I do agree that it's a really interesting and important topic. I also think that, the S in ESG in the context of COVID has kind of come back up in the context of being a really important element for our clients. We actually did a survey and asked people, pre-COVID and post-COVID, how do you weight the S in ESG? And prior to COVID, it was less important. And coming, through COVID and out of COVID, it's equal focus on the E, S, and the G. So one of the things we've been doing is actually we've developed what we call an inclusive growth model, which is kind of an ESG scoring framework with more focus on the S, really looking less at what a company produces and more on how they go about managing their business. So what is the executive and other compensation structures? What's the stakeholder community impact? What's the focus on diversity at all levels of the organization, employee engagement, et cetera, skill, reskilling, training, et cetera. So I do think that, there's a lot of interest in the S and of course the Sustainable Development Goals. So it's great to see. And I think, the next step is how we bring the E, S, and G more closely together from a systems perspective, because all these things are connected.
Thanks for that very...
Sorry, I was just going to say, I think it's another point. The global, element is really important here as well. I mean, when you're looking at sort of remuneration as well, this is why it's so important that we bring, other entities together. And I think, we're beginning to see it on the tax side, which is great. But I think, for remuneration, as Jane says, the US element is problematic for global industries. So I think putting pressure on that is very important. And on the S, I couldn't agree more. I think it is more and more of focus, whether it's sort of the internal culture of a business. But I think fundamentally what has been, the real change through COVID is the use of public policy. We've moved away from this sort of sole focus on monetary policy, which frankly, although necessary response to the financial crisis, was a source of increasing inequality. And you could see that in, sort of financial assets, sort of moving in one direction and real assets, including wages, going nowhere. I think, that policy change that we've seen through globally is a key driver of focus. And I think, fund managers and and corporates are very aware of those social sort of gaps that have arisen, and I think it's going to be a huge opportunity to use the fiscal policy wisely to drive that, and again that creates opportunities to close gaps which are way too wide at the moment.
Thank you, Stephanie, for that. And I think I'd like, we've been flying at 10,000 feet altitude now here, and I'd like us to bring us back down to the policy discussions, which I know is something the large part of our audience would be interested in. And obviously, one of the flagship measures by the EU to embed that more in financial markets, particularly in the investment value chain, has been the SFDR, the Sustainable Finance Disclosure Regulation, we touched upon already. Personally, I find it very interesting that it's a piece of regulation for the first time that looks at ESG from a risk perspective, as well as trying to mainstream this whole impact dimension, starting a discussion on what is the potential impact of those investments. And so I'd like to bring you, Ingrid, in the discussion here. Do you think that SFDR in its current shape is helping that? Is it, did we get it right in moving that forward in mainstreaming it in the financial system?
So I'd say it's helping, definitely, and also challenging. So as I mentioned in earlier remarks, the SFDR introduces this idea of double materiality. So what I mean by that, and you've touched on it, Victor, is it's not just looking at the potential impact of environmental, social and governance risks on the value of investments and factoring that in, but also looking at the negative impacts of investment choices on what Paul calls people and planet. So this is really new. It requires regulated firms to look at both sides of the sustainability coin, and it gets them to start thinking about their role in managing systemic risks and dealing with short-termism. And coming back to some of Jane's comments, starts to make the case for things like more public policy advocacy, engagement and stewardship to manage those risks. So at a high level, it will be quite a familiar idea to what we'd call traditional ethical investors who think about these issues and who have been excluding some of the sin stocks for quite a few years. But I think it's quite new for many other financial institutions, including ESG integrated investors, who'd say, well, we need to think about the financial materiality of these risks, but while there's still a business case to invest in perhaps coal or oil and gas, we're going to carry on doing that. So I think it's now going to start creating new conversations, particularly around ramping up exclusions policies as a result of some of the conclusions these firms might come to, having looked at the impact of investment choices on people and planet. I think one of the challenges, though, is the level of detail that firms are being required to report on around these what we call principal adverse impacts. So I think, Paul, you were one of the main advocates for the inclusion of these details, and I'm sort of on the fence about whether it was the right way to go. In many ways, principles-based approaches in complex areas are the right way to go when we're learning how to do this. On the other hand, we don't have that much time, and we do have an issue with greenwashing. So I do have sympathy with the sort of regulatory approach around this. What we then saw was our environmental regulators in Europe having to work and to design a principal adverse impacts regime from scratch, which is not a task. I would envy them. But they have done so, and we're now left with a need to try to reconcile some of those reporting requirements on these negative impacts with some of the elements of the taxonomy around do no significant harm. So it's very much a sort of evolving picture, but I think, again, it's been a really transformative approach to getting firms really thinking about their responsibilities in managing systemic risks. And I keep focusing on climate. Of course, the social impacts are so important too.
Thanks, Ingrid. Maybe Jane, I'd like to bring you in the conversation here, but do you see any potential drawbacks to the approach we've taken on SFDR as well?
Sure, it's a great question. I mean, it's funny, these PASI indicators, which is the latest of so many of our acronyms in the ESG world, the principal, adverse sustainability impacts. Everybody not everybody in my firm, but a lot of people in my firm know what PASI are, because we're, all over this list. There are 16 indicators that we'll have to report next year as a firm at the firm level, and then from the year after at the fund level. So really exploring, what are these 16? Half of them are already integrated in our ESG scoring. About a third of them are already reflected in our responsible business conduct policies, so our exclusion lists. So if, which ones aren't, is it, are they more significantly business conduct issues? Are they material from a financial perspective? Are there proxies for them if the data doesn't exist? I mean, these are all the questions that we're kind of going through internally now, and there's a bit of a chicken and an egg issue where we may need to report on something before we really have access to high quality, consistent data from companies on it. So there's a bit of a bridging question. So definitely, I think, SFDR has put a lot of these topics front and center. I mean, thankfully for us, I think we were already, for the last few years, really more structurally embedding ESG and our, RBC, responsible business conduct expectations across everything that we do and in our reporting platform. And we had a beat the benchmark objective already on ESG and carbon footprint, which allowed us to transition. So more than 80% of our fund range is category 8 or 9 because of the work we were already doing. So I think for us, it's been a natural evolution. But for me, one of the risks is, I think, we all know that we live in a finite planet. We all need to consider more closely the critical economic, motivation to achieve a low carbon, environmentally sustainable, inclusive economy from an economic perspective that will serve the long-term interests of our clients better than kind of being asleep at the wheel. And so I think from an economic perspective, investing with ESG risks and opportunities in mind and thinking about, how we can all lean in towards creating a more sustainable economic future makes sense from a fiduciary perspective. So to me, one of the risks is that this becomes a compliance exercise. And that, because we need to monitor, report, make sure we don't breach anything, it moves into potentially, a step too far into that realm of compliance where we lose sight of the fact that, like, hey, we need to think about these issues because they're financially material in the near term, because for so many reasons that we're all aware of, but also in the long term, if we don't effectively achieve the Paris Agreement, we're all in trouble, not only from a kind of a moral and an environmental and a social perspective, but from an economic perspective. So the risk is that we move too far into the compliance realm and away from the financial materiality reality around the critical importance of achieving a more sustainable future.
Thanks for that. I think that's really enlightening points, and I've seen a few nods from other panelists as you made those comments. And I think it's indeed my own experience is that if you talk SFDR, data is very important. Data remains a challenge for market participants, but it is maybe more often than not seen as a compliance challenge. And I think the question what's really interesting is, is what we have on the table actually where we, the indicators, other sustainability risk disclosures, in the hope that we get the data, will it actually generate also investment insights from a sustainability perspective? I think that, so I don't know if you Stephanie, have any thoughts on that, on whether that's a likely evolution of the SFDR or those types of policies in the future.
I mean, I don't think anyone doesn't think that sort of the data is central to getting this right, and also at the moment problematic. And Jane pointed to it as well. And I think it's the sort of ongoing cry of fund managers is just getting that sort of consistency of data. I think for us as fund managers, ratings or data has always been a starting point. You're always data aware, not data driven. And I think, the real work comes from the engagement with the businesses and how you see things developing. And you never want to sort of to make decisions on a snapshot today. It is, where are we going from? Having said that, I think, as an observation, I think MIT did sort of some interesting work on this. If you look at credit ratings, for instance, the correlation between the different rating agencies sits at something like 0.99. When you look at ESG ratings, it's more like 0.6. And that's a problem because, these are sticks that, fund managers can get beaten with, but it's kind of, and the corporates can get beaten with, and you don't really know where to look. So I think that there has to be, and there is, and let's face it, I'm sure, all of us are involved, and we've, got people sort of engaged in sort of working groups to sort of try to coalesce around sort of definitions and so on. But I think, even you get to the point where sort of UN sort of compact definitions, differ between rating agencies. So it's really important that we get this right, because once you are aligned, then you can move forward and sort of be much more comfortable with the data you're using. So I think that's the near-term challenge. I think it's the teething problem element of, the point I think Ingrid made right at the beginning, which is this is moving very fast. And so you do have periods where certain bits move ahead, and there's the catch-up point. But I think the data point is crucial, and it's why we're sort of developing in-house tools, and sounds like Jane's group is doing the same, which is trying to collect the best that we can find within all the sort of granular elements within the E, within the S, within the G. But obviously, a lot of time and effort would be saved if we could have a coalesce around a sort of a standard definition that everyone felt comfortable with.
Thanks for that. And maybe that will lead me very nicely to my last question to all of you, and I'll be curious to open the floor and get all your thoughts one by one. Is obviously to solve the data challenge, a lot of focus is on this reporting standards, and we're seeing obviously the EU move very fast in this space. We're seeing the IFRS Foundation getting involved, but and that's my personal view. When you look at it more closely, it seems that there are also regional definitions of what we mean by sustainability and visions of what we have for sustainability. And so the question I often ask myself is actually global convergence in this space possible? Is it desirable, or is it unfortunately maybe utopian? So maybe Paul, if I can get your start off with you first.
Let me have a go at it, but it also links very much to the previous discussion, which was very interesting. And let me come back quickly to that, because what you need is the data to come up with standardized metrics. So that's the standardization of the financial markets, which makes the financial markets, well, regional, European, global in nature, right? So but it shouldn't become a compliance exercise. So when I was having the discussion on the SFDR, I very much wanted to include the due diligence as a way to change, you could say, the fiduciary duty. So that's about the accountability. How do you take into account the sustainability risk, the principal adverse impacts? That is what you need to have, and that you need on the investor side and then at the same time at the corporate side. Like I said, so we are in the middle of this change, and in my mind, systemic change has not been completed, far from it. Standardization is important to have an outreach of global markets, but in the end, you need accountability. And at the level of the investor and the corporate, and we are not there yet. And that also because I know that some of the risks are not high frequency risks, so it may be difficult to collect data on that. That doesn't mean they are not relevant. Take the issue of land grabbing. That's nothing that you can find can get in one metric, but it is relevant, and that is why the accountability of the investor and the corporate comes in. All clever people think about what are the risks on in this case on the local communities. So we need, in that sense, the systemic change towards much more to accountability. And I can very well imagine that accountability may not be global very soon. It would be wonderful, but standardization, yes. I think we can work on collecting the data, making them comparable. What I've seen on asset managers, a huge amount of data are already being collected. It's just that we need to find a metric that we can converge on, rather than so it's not the data itself, it's more the convergence process. Before that, there was a plethora of metrics, everyone using its own metrics and standards, so we're now trying to make it converge. But that's just one part, that's for standardization. And the other, the accountability, I don't think it can be standardized, in fact. If you want to have a board that is accountable, I want them to think about the risk, I want to take them to responsibility. I don't think there is a clear-cut answer, blueprint for taking accountability.
So maybe Marcel, moving on to you, like same question: convergence possible, utopian, desirable? What are your thoughts on that?
Yeah, Victor, the starting point is that there is currently a clear risk of fragmentation across different jurisdictions. More than 20 jurisdictions are currently working on taxonomies, for instance. On the one hand, that's of course a positive. It's a positive sign. A lot of jurisdictions are currently gathering around the principle and the idea. But of course, you can imagine that a lot of complexity and ultimately bureaucracy can come out of a proliferation of different regulatory requirements. So we think that coordination at international level is absolutely necessary, and we also think that the prospects for an increased international coordination in the area of sustainable finance is currently very, very positive. The International Platform on Sustainable Finance has already been mentioned. We launched this platform in late 2019, and 1 year on, broadly, or a little more, we have already a critical mass of policymakers gathered in the international platform. We're working with China, the UK, Japan, India, Canada, Argentina, Chile, and so on and so forth. So there is an appetite for international coordination. Also, the G20 has started again to work on an ambitious sustainable finance agenda. Convergence is the way forward. There is a window. We think that we have to prepare the ground for international standard setting in the area of taxonomies, sustainability disclosures, and other areas to ensure an alignment with our long-term sustainability objectives.
Well, thank you very much, Marcel, for those positive words at the end. I think we've reached the allotted time for our panel today, so I wanted to thank you, Jane, Stephanie, Ingrid, Paul, Marcel, for your incredibly fascinating comments and I think the lively discussion. So thanks for providing those insights, and thank you for the audience to listening to us. And now I will be passing over back to Dan Kraft of Forum Europe.
Victor, thank you very much. And again, I'd like to echo your thanks to all of our panelists. Thank you all very much for a fascinating discussion. And Victor, to yourself as well for excellently moderating the discussion too. So thank you all very much. A really interesting discussion, and I'm sure one that there's lots more debate and discussion to be had about. And I think it's one of the key themes that but really interesting. So thank you all so much for that. So we're now going to be moving again to another short break. So we have around about 20 minutes or so before our next session starts. But during the break, we're actually going to be showing a short video interview that our event partners, CREAB, have filmed with Karine Kraus from Veolia, which again will be focusing on some of the issues on sustainable investment that have been discussed here in this last session. So that's going to be showing very shortly on the main stage. So that's going to be starting here. The interview is actually also available to watch on demand via CREAB's Expo booth in the exhibition area for the duration of the event. But that will be ready to start here now. And then we're going to be returning with our next panel in around about 20 minutes or so, back here again on the main stage. And that panel is going to be focusing on central bank digital currencies. So back here in around 20 minutes or so for that. But in the meantime, please do stick around if you wanted to watch the video interview, or the expo area, of course, is still open, as is the networking area. Thank you very much once again to Victor and to all of our panelists, and we'll see you here back in around about 20 minutes. Thank you.
Good morning, everybody, and welcome to this side event of the Financial Services Forum. My name is Alberta Laschena. I'm a partner at CREAB dealing with competition and investments. And I welcome today Karine Kraus, Senior Vice President Sustainable Development at Veolia. Karine has a career at Veolia starting in the energy department. Then she was director in the cabinet of the CEO, and now she is senior vice president of sustainable development at the company. Karine will talk to us about taxonomy and how this will impact companies like Veolia, active in the circular economy, and especially in these challenging times with the Zero Pollution Action Plan and the plans of the Commission on this field. So, Karine, would you like to introduce first Veolia, the company, and the role of the company in the ecological transformation in Europe, and the strategy for the next months and years?
Yes, thanks a lot, Alberta. Maybe some words about me. I've been working at Veolia for 9 years, as you said. And before that, I started my career in the civil service when I held several positions in the Treasury Department in France, at the French State Holdings Agency, and as a senior member of the Ministry of Industry Cabinet. So I'm therefore very sensitive to regulatory issues. both because of my background as a civil servant, but also because of my years of experience as head of BU of energy, where I know to what extent regulations can impact a business model for incentive, or on the other side, the obstacles we can create. So taxonomy is very important for me, and very happy to share some views about taxonomy today. So maybe a few words about Veolia. I think lots of people know Veolia. We are convinced at Veolia of the importance of and immediacy of environmental issues, because they have always been at the core business and DNA of Veolia Group. We have been created 170 years ago in Lyon, in France, to meet public health challenge. And we are working on three main issues, which are the management of water, waste, and energy resources. As you know, as you are aware, we have a merger going on with Suez, and we intend to create a global champion of ecological transformation and to offer Europe a reference player in a sector, environment and ecology, that is, as our CEO, Antoine Frérot, says, probably the most important of this century. We are deeply convinced that ecological transformation is not a side action for companies. We are deeply convinced that it's a core business for all sectors. We are convinced at Veolia that ecological transformation is to the 1920s what the digital transformation was maybe 20 years ago. And so our aim and our raison d'être, our purpose, as we say, is to help other companies to cope with this challenge of ecological transformation. And so it's why, obviously, taxonomy is very important for us.
So have you then, let's say the Commission and is, as you know, finalizing the delegated act, the first part of them. There has been a long discussion on sustainable finance, on taxonomy. Do you think that the work of the Commission is on the right track to help finance and support activities like the one that, and huge investments that Veolia is carrying out at the moment?
Yes, definitely. This is obviously important that the European Union has taken up the issue of taxonomy. I think we all know for a long time that the development of standards, whether related to accounting, tax, or commercial relation, is key for states and for companies. And therefore, taxonomy is key. Maybe just to remind all of us, taxonomy aims at classifying activities according whether they are green or not. This classification will therefore have very important consequences on the ability of companies to finance themselves, because, as you know, the main players in finance give an increasingly important place to extra financial criteria. It will be a good development lever for the activities which will be classified as green. Maybe you notice it's very interesting to note that many US companies have been accelerating this last month their ESG reporting because they need to meet ESG criteria and to obtain financing. For this reason, taxonomy exercise is key. And I think it's very important that the EU has taken the lead in these matters, and this lead should not be lost. For instance, in the United States, they are in the process of defining what they mean by green activities. It would be a shame, in a way, for the EU to let the train pass by and to let other bodies define the rules that will apply to our countries. So we think at Veolia that it's therefore an excellent initiative for the EU to take up the subject of taxonomy, and it is to be hoped that the adoption of the text will be rapid and coherent, so that the European taxonomy can set the precedent at the global level. We hope that the European taxonomy will set the level. So it seems very important for us that these new rules are clear, readable, because not only so they can be easily implemented in European companies, but also we will make sure that they are attractive outside of Europe, which is very important also.
So Veolia is already, let's say, applying relevant rules or following rules on taxonomy when defining its investment. Can you make, for example, an example on this of recent investments that Veolia decided on this field?
Yes, sure.
That follow the taxonomy already?
Sure. I think overall we are quite satisfied with the taxonomy, and that waste management and circular economies are well taken into account so far. You mentioned the first delegated act on climate change adaptation and mitigation. It takes into account a certain number of activities, such as collection, biogas capture from landfills, which is very important for us, sorting and recycling, anaerobic digestion or composting. The criteria selected seem to us to be quite ambitious, and I think it should make it possible to direct public and private investment toward these activities in the future. The work which is going on the second delegated act should be an opportunity to further develop this emphasis on hazardous and non-hazardous waste management activities. So overall, we are quite happy and satisfied with the taxonomy and circular activity. There is, however, a problem for us, which is the treatment of incineration of waste. As you know, for waste management, we have some levels of treatment hierarchy. We have prevention, then reuse, then recycling. And this different treatment must be planned and financed as a matter of priority in order to go to sustainability. However, a fraction of the waste which is produced is not recyclable and must be treated in the best technical and environmental conditions, and best conditions are incineration. Because as a next step after recycling, incineration capacities will be needed, as shown by lots of countries in waste management. We are deeply convinced that a high level of recycling goes hand in hand with adequate but necessary incineration capacities. And so we think we should open the debate on incineration, that is to say, how to make incineration sustainable and compatible with the objectives of prevention, reuse, and recycling of the Green Deal. So we think that a taxonomy is an opportunity to address this issue and to establish some clear criteria for sustainable incineration. So to put it in a nutshell, at Veolia, we are satisfied with the current proposal on taxonomy and circular economy, which is a recognition of our strategic priorities and on the ecological transformation, even though we think we need to address the issue of sustainable incineration, but we have no doubt that we'll do it in the next weeks and months.
Let's say that there has been a lot of debate in Brussels about the inclusion in the delegated act of natural gas and nuclear. The decision was to not include this anymore in this first package of delegated act, to have more reflection on this. This because there are some member states, especially Central European, that are not yet ready to exit natural gas. What is the position in this on this point of Veolia?
At Veolia, and much more because we are a French company, we paid a lot of attention on nuclear. We don't have nuclear activities in France, but it was a hot topic, and gas, which, as you said, have given a lot of debate in taxonomy. As regards natural gas, which is one of the activities of Veolia, and as you said, there was a strong opposition from some EU members. The European Commission has decided that there will be two separate initiatives, if we understand well. When the first one will be in Q3 21, there will be a complementary delegated act covering whether and how certain activities can fit into the taxonomy framework, specifically with regard to nuclear, as we say, natural gas and agriculture. And specifically with respect to natural gas, we think that we should look at the merits of a sunset clause for transitional activities. We think it will be very important. And there will be also at Q4 an independent legislative proposal by the Commission on decarbonization and financing the transition. The proposal, as we understand it, is expected to cover the gas activities that contribute to reducing greenhouse gas emissions, but cannot be covered within the EU taxonomy as they do not meet the screening criteria. It will be a standalone legislation, which might be part of what is called the gas package, which is likely to be published at that time. So for Veolia, we welcome very deeply upcoming discussion that will clarify the role of natural gas in the energy transition. We think it's important to ensure that existing gas network and facilities will play a role in the cost-effective decarbonization of the entire energy system. So we think natural gas, we hope, will be part of this package at the end of the year. So I think for us, we think the European Union has a unique opportunity to shape the next decade with this initiative, both geopolitically in a way, in the conduct of business, and more globally in environmental transformation. We think that Europe has already a considerable lead in ESG regulation and climate requirements. We need to maintain it. So we need to get, as we like to say, sustainability in motion. So we think taxonomy is a very good way to do it. And we need to further the discussion on some things which are important for Veolia, as I said, like incineration of natural gas. But overall, we think that taxonomy is a very effective way to get sustainability in motion.
And to accelerate the transformation.
Exactly.
Okay. Karina, I thank you, and we thank you very much for this opportunity and for having shared with us the position of Veolia on sustainable finance and taxonomy. I give the floor back to the Financial Services Forum, and I thank you again for your intervention and for the time dedicated.
And thank you, Alberta, for your question, and thank you for giving me the opportunity to discuss this very important issue for us.
Thank you again.